Hello guys and welcome to another video. So I've just listened to a lot of podcasts. I'm on my day off today and I've listened to a lot of podcasts about compounding. A lot of people are talking about how the power of compounding is insane. You start off with a smaller amount of money. If you're consistent and you keep it within a good growth stock or whatever it might be, the compounds do wonders. So your money multiplies. How does that really work? I've made a spreadsheet. So let's have a look at the spreadsheet and see where we get to. So what have I assumed? I've done a bit of research and historically S&P 500 has been growing at 10, actually just over 10% a year. So for S&P 500, which is the sort of biggest 500 companies in the US, 10% growth is I think very reasonable. FTSE 100, which is 100 UK biggest companies, are growing at about 6% per year historically. That's been relatively decent figure. And then some good tech funds that are focused around technology, especially in the last sort of 10, 20 years. Some of them have been growing at 15% a year. This is very rare. It's very difficult to get one that consistently goes 15% or above every year. I think a lot of them fell after during the financial crisis, the dot-com bubble, things like that. But there have been some that have been strong enough to sustain this growth. And then you've got just putting money in the bank at 2%. So that's related very highly to inflation. So it depends. The inflation and the interest rate have a correlation. So when the inflation is very high, you'll have a much higher interest rate in your savings accounts. And then when it's low, you'll have a lower interest rate in your savings account. It's a lot more complicated than that. I still just need to study it myself. I might do more spreadsheets, but I just took 2% just because in our lifetimes inflation has been mostly low and the savings percentage has been around that. I know it's higher now, but I think it might drop again in the future. So let's have a look. This is taking 3 examples. So there is a UK ISA account that you can open and you can invest up to £20,000 a year tax-free. So whatever tax dividends you get on your investments, you will not be taxed on it as long as it's less than 20,000 a year, and obviously you can accumulate that. So I haven't been doing it, which is probably something I should have been doing, but people that have maybe been doing it for 10 years, if they're rich enough to do that, they could have been putting in 20 grand a year. For 10 years, that's 200 grand plus all the compounded interest that they would have accumulated in the stock market. So something to consider. So I've got 2%, 6%, 10%, and 15%. And then for each one, in this example, we're going to assume £5,000 per year contribution. So every year you put in 5,000 into that account. 10,000 every year you put 10,000 into that account, and 20,000 every year you put 20,000 into the account. We can assume more, but for now let's just stick to 5, 10, 20,000. 5,000 per year is around £400 a month. It's very doable, especially if you're a couple, for example. 20,000 a year is almost 2k a month. Again, it's a lot, but it's doable for somebody who's really focused on this wealth creation. So if you are at the 2%, for the £5,000 a year savings, you'll be going from 5k to 26k in year 5, 55k, 88k, and over the 30 period, you'll grow it from 5k to 206k. You're investing 5k a year for 30 years, so you would have invested 150k and you would have gained another 50 in interest. So sounds reasonable, but not overly exciting because you have to wait 30 years to get that growth. For 10k, you're going from 10,200 for year 1. By year 30, you're 413,000. Again, so 10k for 30 years, 300,000 invested, and you got just over 100k compounding on that. And then 20k, over 30 years, you invest 600,000, but your balance is 827,000. So relatively decent. You're making 227,000. Probably the issue with all of those is that the inflation is often higher than 2%. So in reality, you would actually be losing money. You wouldn't be gaining in terms of that amount because say for this one, £20,000, you invested that for 30 years. So it means that you've invested £600,000, but in 30 years you have 827,000, so 200,000 more, right? But what you can buy right now with £600,000, you cannot buy with 827 in 30 years time. So you've actually lost money. So 2% is not great, and that's why bank is not great overall. FTSE 100, 6%, right? So if you are starting with 5,000, invest that every year, you grow it to 419,000. So as you can see, that is good. That's quite reasonable. You are investing 150, getting 420. So not bad. Even over 10 years, you're investing 50,000, but you're getting 69. So this shows the compounding, right? So year 1, 5,300. Year 10, you invested 50k, got 69. Year 20, you've invested 100k, got 194. So as you keep growing, as you keep in it longer and longer, the interest on the amount just keeps getting higher and higher as the amount, not as a percentage, but as the amount, and that keeps compounding because every year you get the interest added on, and then the following year the interest is on that money plus the interest from the previous year, and it compounds. So 6 goes from 5 to 400. If you're doing 10k a year, it goes from 10 to 838, which is again reasonable because 10k a year for 30 years is 300,000. And if you've got that 6% return, you're going from 300,000 to 838,000, so almost tripling your money. In here, you've got 20k. Over 30 years, that's 600,000, and you actually get 1.6. So again, pretty much tripling your money. If you were in S&P 500 that whole time, your 5k over the 30 years goes up to almost $1 million, which is crazy. That's, as a couple, you're potentially, say you're a couple that's 30 years old, you just start putting in £200 a month each, and you do that, you keep putting that in for 30 years, and you can end up with $1 million in there. That is crazy if you get that sort of return. If you do 10k, you're going to get 1.8 million. Again, very reasonable. That's less than 1,000 a month. If you keep doing it, yes, 30 years is a crazy amount of time, but even if you do it for 20 years, in 20 years you put in 200,000, but you get back 630,000. Very, very good. And then the 22k turns into 3.6 million, so 20k for 30 years, 600,000, you actually get 3.6 million at 10% return. So you get 6 times your money, and that definitely beats inflation in most cases. And then if you're lucky or you're super experienced and you can find 15% stocks, your 5k will go to 2.5 million. So you would have invested 5k over 30 years, which is 150,000. You're going to have 2.5 million. 150,000, 2.5 million. Crazy. 10,000 going into 5 million. So 300k invested, 5 million in the account. 20,000, 600k invested, almost 10 million pounds in the account. That just shows you that over time, goes crazy. It's smaller, but as the numbers get bigger, as you wait, especially in the last 5 to 10 years, that growth is insane. So that's really interesting. So that gives you an idea of investing into this compounding theory, which is really, really true, at 2%, 6%, 10%, and 15%, and then at 5k a year, 10k a year, and 20k a year. So that gives you all the numbers. Happy to share them. So that surprised me. That made me open the ISA account. I've not invested yet, but I really want to start because I'm thinking, wow, I've been missing out. I'm in my 30s now, and I've been missing out on this for a long time. Now let's look at a one-off. So what I thought is, this is you being extremely disciplined every year, putting in a certain amount that you've agreed for a long time. That's how you build the wealth. What if you have a bit of money and you put it into an account which is 2, 6, 10, or 15%, and you just leave it there? You have a little bit of money, you put it in, no more investments into it. You put it in and just almost treat it as a loss, right? So you've got 10k sitting there, pay it into this account, forget about it. Just say, wow, someone scammed me for 10k. Just forget about it. Then after 20 or 30 years, go back into that account, and then you'll see the magic of compounding. So if you were to try that, what would happen? Okay, at the 2%, you're not going to see much magic, right? So that is what it is. If you are 5k invested 5k, you forget about it for 30 years, you're retiring, old guy or woman, you go back into it, you're at 9k. The prices by that point is way higher. So at 2k, it's not really worth it no matter what, and definitely not worth it at keeping cash and stuff like that, because that's 0%. That's even worse. 6%. If you have £5,000, at 6%, you put it away. Assume, right, I've spent that 5 grand, it's gone, I forget about it. Then you set a reminder for 20 or 30 years. What would happen? Well, in 20 years' time, that 5k turns into 16k, so it triples at the 6% interest rate. Not bad. After 30 years, it goes from 5k to 28k. So really, really impressive now. If you do 10 or 20k, which is more likely, so say 10k goes into 57k after 30 years. 20,000 becomes 114,000. So 20,000 is a lot of money to have there and to just assume that you've been scammed with. But the reward is decent. You lock away that 20,000. If this performs at 6% average, you'll get 114,000 back. So that's 6 times as much money. So very impressive. Then you go into bigger numbers, and at 10%, let's see, at 10%, you are 5k turns into 87k, 10k turns into 174k, 20k turns into 350k. Imagine that. That is huge. I mean, even inflation taken into account, that is absolutely huge. You have 20k sitting there. You're thinking, right, I'm going to be using it for deposits. I'm going to use it for this, that. No, don't do that. Lock it away in a investment account. Forget about it for as long as possible. You're 30, open it again at pension. Don't open it before. Just open it again at pension. So you put that in. At 30, £20,000, big loss. It's going to take a bit of grieving. What a shame. At 60, you open it. You got 350k sitting there. You haven't had to put any more in. It's just grown naturally and compounded naturally. That's crazy. And then at 15%, that's where things get completely wild. So if you're able to get that level of return, which is hard, it's very hard to find one particular stock that for 30 years is going to be performing that well. But if you did, 5k turns into 330k. 5k at the moment is like a very average little car. You put that away. Just assume, yes, I bought this car, it broke and I had to write it off and I didn't get anything for it. In 30 years, 330k. £10,000, 662k after 30 years. Even after 20 years, still 163k. From 10,000, 11 is after the first year. And if you have £20,000, after 20 years, you're at 327,000 and you're up to 1.3 million. The crazy thing is, if you left it for even longer, it would compound even more and it would get even crazier. So those are the results that I wanted to share with you. I'm a bit shocked myself because you just don't think about it like that. You think, right, if I leave it there with the interest, you might get a grand or two, you might get a few grand, but that's it. But you can literally triple, quadruple, whatever the 6x thing is over that length of time. So it's really worth considering. I'm now seriously looking into it and planning my financial future. I hope it helped you as well. It gives you exact numbers of what happens at each investment level and each investment percentage. Drop comments below to tell me how you found it, see if you want me to do anything similar. Subscribe, like the video, and see you in the next one. Thanks, guys.